the leverage that monetary policy has had over the economy over the last 60 years has been weakening. And it implies that at some point in time, there's a real risk that we'll reach an economic malaise or recessionary period where the Fed monetary policy won't be as effective as in the past. And that will imply that economic growth will stay weaker for a longer period of time. And that's really my expectation. I think we're close to a secular bear market in the stock market as well. It may have already begun with the high in January of last year.
You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. You are listening to and watching the Financial Survival Network. I'm your host, Kerry Lutz. And hey, it's mid-October, October 17th. Well, we got good news for you and bad news. Jim Welsh is back on the show. That's the good news. But what he's about to tell you is really the bad news. Jim, it's great to have you back. So basically, you're going to explain the world to us in 3 charts. And I think that will pretty much clear up everything, won't it?
Absolutely. I mean, we're 2 weeks ahead of Halloween. Why wait?
Yeah, why wait? All right. So I'm going to share the screen with you. Share those charts with us, please. Tell us what's going on here.
Well, let me get this up here. All right. So the upper left chart that my arrow is pointing to, and you'll be able to go to Kerry's website and maybe blow these things up to see them more.
We'll have a link. Well, got the link for you, and you'll be able to look at them all.
All right. So the first chart is the long-term chart of Treasury bond prices. So as most people know, bond yields peaked back in 1981, and as they've come down, Treasury prices went up. And so you can see this 40-year uptrend has been broken in the last 18 months or so. And the implication, Kerry, is that we're beginning, I believe, a new secular bear market in bonds. Now, what many people may not know is that from 1946 to 1981, we had a 35-year window of time where Treasury yields just worked their way higher, which was then followed by this 40-year period where rates came down. So the implications here are fairly significant in the sense that cheaper money in terms of borrowing costs for businesses and consumers over the last 20, 30 years has obviously spurred economic growth and demand. And if indeed a secular bear market has begun in the bond market, on balance, Treasury yields, corporate yields, borrowing costs in general are going to be higher. And that has implications for the economy because one of the things that helped the economy grow faster was indeed lower borrowing costs. And the chart right to the right of it is the correlation between bond prices and the stock market. Over the last 20 years, a lot of financial advisors and a lot of investors were really bailed out in 2001 and 2 in the financial crisis, 2008, because bond prices rallied as the stock market went down. So if you had an allocation of 40% to bonds, 60% to equities, the bond allocation really helped minimize and reduce the total loss to your portfolio. And I wrote a piece in June of 2021, basically saying, I think this negative correlation window is going to be ending, and we're going to see bonds and stocks revert back to the pattern that existed for most of the time from 1945 to 2000. And in that window of time, Kerry, bond prices and stock prices moved up and down together. So that in the 73, 74 bear market, bond prices were going down just as much as the stock market was going down. And what we saw last year is that 60-40 portfolio had its worst performance ever. We've seen bond prices dropped significantly last year, in addition to equity prices falling. So the combination of these two charts, Kerry, suggests to me that the formula that financial advisors and most investors have used in terms of a 60-40 or something close to that allocation to stocks and bonds is going to be very problematic if we've entered a window of a secular bear market in bonds. And what we've seen even this year, when rates have gone up noticeably, equities have sold off. And so that correlation continues to hold. So that to me is the longer term, big picture that I think investors really need to understand and respect. And it'll be hard because everybody's been living in a world the last 20 plus years where most of the time bond yields and having them in your portfolio really help balance what was going on in the equity side of the equation.
Right. So that's kind of profound because it basically throws water on the whole investment philosophy for the past 40 years. And it was valid for the most part for the past 40 years because the Fed could always cut rates further. And we had a downtrend in rates. So that would kind of bail everybody out.
Yep. They could exercise and again, from a bigger picture standpoint, if you think about it, for most of the last 60 years or so, whenever the economy slowed, the Fed would cut rates to stimulate growth. And what we started to see in 2001 is the Fed decided, now we have to push the real rate to minus. Okay, so the Fed funds rate hung out at 1% for a number of years, even though inflation was above 1%. And then in response to the financial crisis, not only did they drive the funds rate down to zero, they also expanded their portfolio, the balance sheet of the Fed, from $700 billion in 2007 to almost $9 trillion a year ago. So to me, what it implies, Kerry, is that the efficacy, the leverage that monetary policy has had over the economy over the last 60 years has been weakening. And it implies that at some point in time, there's a real risk that we'll reach an economic malaise or recessionary period where the Fed monetary policy won't be as effective as in the past. And that will imply that economic growth will stay weaker for a longer period of time. And that's really my expectation. I think we're close to a secular bear market in the stock market as well. It may have already begun with the high in January of last year. But all these pieces are starting to come together. That implies that equity investors are going to struggle for the next 10 to 15 years in a secular bear market.
Wow. All right, 10 to 15 years, which is longer than the average person on Wall Street has been in their job, right?
Probably. And again, this may sound like, oh my God, this is kind of extreme. Well, if you go back 100, 200 years in terms of looking at the Dow Jones Industrial Average, there have been other windows of time where you had these secular bear markets, the most recent, 1966 to 1982. So it's not like I'm talking about something that's never happened before, or, oh my God, here's a guy just trying to be negative to grab a headline. No, I'm just trying to do economic analysis and keep my eyes open so that, I don't get run over and my subscribers don't get run over either.
Right. Hey, what about the concept here that, if you had invested $1 in 1929, all right, to become whole again, I think you weren't whole again until 1958?
53. I think it was 1954. That's a really long time. Yeah.
And, that because to get you to invest in the market, they're always saying, over time, you've made money, 10% a year, whatever. Right. But there was that period of time in those protracted bear markets where you didn't make any money, right?
Right. And I think the problems that we're facing, Kerry, in terms of comparing what might happen in the next 10, 15 years to what happened in 66 to 1982, I think some of the problems we're facing are more significant. I mean, back in that window of time, 66 to 82, debt to GDP ratio was like 30%. We're at 120%. So we've spent a lot of fiscal bullets, if you will, again, trying to get the economy to grow. In the 1960s, for every $1 of debt, it generated about 90 cents of GDP. Now it's less than 50 cents. So my point is that fiscal stimulus is having less of a impact on generating economic growth because we have so much debt already, and the amount of debt service, which has been suppressed for the last 15, 20 years via monetary policy, that has obviously changed. That debt service is a drag on economic growth, along with a number of other things. We don't have time to go in. The third chart on the left, because we'll talk about the economy and inflation. So a lot of economists say, oh my God, inflation's behind us. Paul Krugman said, it was transitory after all, and so forth. And the thing I've written about in recent months that I think most economists and maybe many politicians are overlooking is that prices went up for many things that people live on and day to day by 40%.
Needs, not wants.
Exactly. Up 40%, and wages during the last 20 months are up about 18%. So yes, the consumer price index has come down. It's important to understand the math on how that is calculated. It's a 12-month rate of change. So something goes from $1 to $1.40 and then stays at $1.40 for the next 12 months, the rate of change is going to slow until it's zero. But the reality is I'm still spending $1.40 for something that used to cost $1 3 years ago, and my wages have only gone up 18%. This is why I think a lot of consumer sentiment surveys show that people are less optimistic about the future. Why? Well, because they're struggling to make ends meet, even though supposedly inflation has come down. And the next chart, the fourth chart there, is a chart of excess savings. So as we know, the government sent out trillions of dollars to consumers. Consumers weren't able to spend while things were shut down. They amassed over $2 trillion worth of savings. The San Francisco Fed has estimated that will basically, for 80% of consumers, be gone at the end of September. Now, I've seen other estimates carried, and they're like, well, there's still this much and so forth. The point being is that consumers, especially the lower income folks, have probably burned through most of the savings they accumulated. And that's why the squeeze on their incomes because of higher inflation is most pronounced. And this is another reason why the economy has held up better than many people expected. Remember last year, everyone was talking about a recession. I was not in the camp. I said no recession in 2022, no recession in the first half of 2023. My take is as things like the excess savings, it's worn down, the increase in student loan payments, and the impact from rising lending standards, which have gone up most aggressively in 40 years, all that's coming to bear in the next 6 months. So I think we're going to see the economy slow more markedly than most people are at this point in time expecting. Because now most economists on Wall Street think we're not going to have a recession. It's like the perfect setup, where, last year everyone thought a recession was coming. They were wrong. Now they think a recession isn't going to happen. I think there's a good chance they're going to be wrong.
Yeah, imagine if they threw a recession, Jim, and nobody came.
Well, they couldn't afford to. I mean, they'd be, depending on the ticket price, right?
Oh, what's that old saw? Economists have called 5 out of the last 2 recessions.
It's close to that, something like that. But again, when they were all talking about recession last year, it was because there were 2 negative quarters of GDP, first and second quarter of last year. Historically, whenever there's been 2 consecutive quarters of negative GDP, there has been a recession. But there's so many unique and remarkable features to this recovery because of the pandemic and the fiscal and monetary response that they took that formula with like blinders. Well, wait a second. If we're in a recession, why are we generating 350 to 400,000 jobs every month in the first half of 2022?
Yeah.
It didn't add up. It was just kind of, okay, this is what the formula. The other thing is, I like to say there's always a a bull market and herd mentality on Wall Street. Because if when Powell said inflation was going to be transitory in June 2021, and I disagree with them, and I'm wrong, that could be a career problem. If I agree with Chair Powell and everybody's wrong, there's, I guess, safety in numbers. So, anyway, so the fifth chart is a chart of the dollar. I turned bullish on the dollar in July as it was trading under 100. I thought a rally to 104 was coming, and if it got above 104, then it would run up to 105.88. It got to about 107.34. I think the dollar's near a high, and trading the dollar has been very important because last year, as the stock market went down, Treasury yields went down, the dollar rallied into October. My view last October was the dollar was topping. And if that proved correct, I thought it would drop from around 114 to 105. We would see rallies in all the things that went down, namely stocks and bonds and gold. So, the correlation between a strong dollar and weakness in all the other markets has been really, really high. Doesn't always last that way, forever, but it has been in the last 2 years. So the point being is if the dollar pulls back, that should take some of the pressure, downside pressure, off of other markets. And the next chart is of gold. In May, I thought gold would pull back to under 1850. And I guess the bigger picture was, and you and I have done interviews back in July, I said, hey, you got 5 waves up in gold. That suggests that an important major bottom has been made when gold traded down around 1616 in September of last year.
Yeah.
But that 5 wave up meant, Kerry, we're going to have a pullback for a wave 2. I think that completed last week. And we've begun wave 3, which I believe will take gold to 2,300, maybe even higher.
You sounded like an Elliott wave theorist here, Jim.
Well, I use Elliott wave theory. I mean, I've been doing it since 1981. I started off in 1981, Kerry, doing hand-drawn charts of the Dow every hour. Okay, so I'm not.
That is. My memory only goes back. I remember very well what it is, but most of you out there don't, because you don't even know what a bear market is.
Yeah. So it's just a pattern analysis. Certain patterns show up, and they can provide information. To me, I try to tie all this happy stuff in with economic analysis, the fundamental side of the equation. I have a much higher conviction of what I think is going to happen when the two sides come together. So I think the dollar is going to pull back. I think fundamentally the Fed isn't going to be raising rates in the near term anymore. That should cause a pullback. I think Europe is in a recession. That means the euro is going to be, I think, on balance weaker, and it's 57% of the dollar index. So going back to gold, I think what we've seen is the beginning of this wave 3 rally to higher prices. There's resistance at 1980. That's that horizontal line. And then obviously up near the 2050. So typically you're going to have a move up, then you're going to have a pullback, and then the takeoff. And so my guess is gold will rally up at least to 1980, maybe get up to the 2025, then have a pullback. And then I think in the first half of next year, gold's going to really make a big move to the upside. As the economy weakens, the dollar is going to weaken because people will start to anticipate when the Fed is going to be cutting rates. That, I think, is going to be very supportive for gold.
Okay. All right. Next chart.
This chart is the bottom left one now is the Treasury yields. On July 27th, the Bank of Japan said, we're going to raise the ceiling on our 10-year Treasury note from 50 basis points to 1%. And when that happened, Kerry, I'm like, this is going to raise global interest rates across the board.
Mm-hmm.
Now, what we've also seen, obviously, is all of a sudden people are waking up to, oh, my goodness, we have a $2 trillion deficit. That has never happened during a period of time when the economy was growing. Only in times when, we got a recession, let's spend a bunch of money.
More proof we've really been in a recession when you take into effect real rates of growth rather than these fake numbers that are inflated by inflation.
Well, I mean, at the same time, I got to take the numbers that are being showed. I don't disagree with you. At the same time, again, you still see a lot of statistics showing spending's up. And even after inflation, because inflation has come down, some of these numbers, I mean, nominal GDP growth, I think, is probably 6 to 7%, and inflation by the PCE is around 4, maybe a touch under. So, there was a window of time where real incomes were declining, real GDP was negative because of the big surge in inflation. Because inflation has come down, some of those numbers are positive. But besides that, to me, the thing here is that the supply issue, at a time where the Fed was buying $65 billion of Treasury paper every single month, so you had this huge shift in the balance between supply and demand. Supply is ratcheting higher and the demand is coming down because the Fed isn't buying anymore. Countries like China has actually been a net seller. Japan isn't buying as much. So, and you've got this outlook regarding inflation.
Right.
Is the Fed going to be cutting rates and so forth? So I think pension funds, insurance companies have been a little reluctant to buy. Last week, there was a 10 and 30-year auction that went very poorly, added to the spike we've seen in Treasury yields. So from a chart analysis, that blue trend line shows a breakout. To me, the first sign that Treasury yields have peaked is when the 10 and 30-year get below that blue line, and then the red horizontal line is like we've seen higher highs in yields and higher lows. That's the definition of an uptrend. So we need to see, in my view, the dollar reverse lower. I think we'll see Treasury yields come down, especially over the next 6 months or so when data starts to show the economy is indeed slowing. But in the near term, they can still continue to spike higher. And, the trend is your friend until proven otherwise.
Until the
trend is higher.
Until the end.
Until the end, And lastly, the S&P 500, it peaked in late July, early August. I was looking for a 5 to 7% pullback. The decline was 7.9% in the S&P. You can see there's a downtrend still in place. I thought that yesterday's weekly technical review, I thought the S&P would rally to 4401. There's a gap there that normally gets closed.
Right.
And some rather retracements up around 4425. So to me, we're at an interesting juncture here, Kerry, because as long as the economy shows signs that it's doing okay, that's a positive for the stock market, because Wall Street has this idea, no recession means earnings are going to go up next year and in 2025. And that's what's kept them bullish. So I think there's a chance the S&P could have one more rally that gets above 4607, the high that we saw in late July. But if I'm right about the economy slowing materially next year, I think the S&P is going to have a very, very difficult year next year. A decline back towards the 3,500 or possibly lower, I think would set up once we have definitive signs the economy is slowing down. Earnings estimates will get cut, PE ratio will compress. So again, as I said at the very beginning, a buy and hold strategy using 60-40, I think is not going to be very successful over the next 10 to 15 years as we deal with a lot of these big problems.
All right. Well, I think you summed it up quite well. Tough times ahead. You really could, and I might write an article about this, and I will totally credit you. 6 charts that prove that we're heading for an economic bust. And I mean, the case is very clear. It's very.
Yeah, I know. So there's demographic problems, in terms of the birth rate is the lowest a couple of years ago since 1937. Well, what that tells us, Kerry, is that the number of people entering the labor market 20, 25 years from now is going to be less than what we've seen over the last 20, 25 years in the past.
Like China. Exactly like what's
not as bad as China. China is horrific, all right?
Yeah.
Because of their one-child policy. But the point being is one of the drivers of economic growth over the long term is how many people are entering the labor market. And given our birth rate, That suggests that will add maybe 0.3% to GDP growth over the next 20 years. So we're in a window of time where GDP growth will likely be less than 2% at a time when we have enormous debt needs, higher interest expense consuming more of the federal budget, wrestling with what do we do with entitlement spending, Social Security, Medicare, and so forth.
Good question.
It's not going to be easy from a society standpoint.
All good questions. Questions. Hey, appreciate you coming on macrotides.com. And I suggest you go there. The link will be in the show notes. This interview, we will give you a link for these 6 charts so you can follow along, whether you're on video or audio. And Jim, really appreciate you coming on. Question for Jim, myself, kl@kerrylutz.com. That's the email address. And hey, you can find all this info in the show notes of this interview on financialsurvivalnetwork.com. Just click that you want to sign up for the newsletter. Jim, we'll be talking to you again soon. Thanks so much for coming on.
As always, Kerry, thanks very much. Like having our conversations. We covered a lot of ground today.
Certainly did, and it's appreciated.
You're welcome.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.